Hi, this is Brian J. Decker. Welcome to this week's market update. I want to tell you about the markets, the Fed, interest rates, the valuation of the market, and we'll cover that all in the next couple minutes. First of all, the market is valued higher, and this is a broken record, I apologize, but we are at a very high valuation. And I want to tell you in this segment why that is. When interest rates are very high, like 8, 9, or 10%, a lot of people don't feel a need to put their money in the stock market because if I can get a 5 or 10-year CD at 8%, why take any risk? But when you've got a 7 to 10-year CD rate at 1%, a lot of people in this country are taking their chances, going for dividend yields, and they're in the stock market trying to get some kind of a return because they can't get it with treasuries, agencies, mortgage backs, corporates, and CDs. The rates are too low right now. So that's one of the main reasons the market's high. The second reason is the Fed. Typically a Keynesian solution to a market trough, an economic downturn like a recession, is to pump the economy hard with Fed stimulus, and then you get that turned around. The problem is we never took the patient off the adrenaline, and the pumping of the markets has continued with every little drop in the market. The Fed is the white hat cavalry that rides to the rescue, and now investors are emboldened to say, I'm going to invest all my money in the stock market because it won't go down. The Fed won't allow it to go down. There's a lot of people who think that way. So we have valuations and market bubbles in all kinds of different markets because of the low interest rates and the feeling that the Fed will save the economy no matter what. A few bubbles to mention are Bitcoin. Bitcoin a month ago was $23,000. It went to 42, and then over the weekend pulled back to 32, and now it's bouncing around. But that's one bubble. The second bubble is when interest rates are this low is real estate. You can borrow and leverage when your 30-year mortgage is at 2.5%. You can buy much more home than you could when interest rates on your 30-year mortgage were at twice that, at 5%. Another bubble in the markets are things like Tesla. Tesla is where Elon Musk said about a year ago at $140 a share that his stock for the company was overvalued. Now it's $800 a share, and the market capitalization, share times share price, is more than the combined market valuation of all the world automakers combined. Do they have an electronic vehicle solution that's a competitor of Elon Musk Tesla? Yes, they all do. Sorry. And are they interested in competing and grabbing market share? Yes, all of them are. And it's a razor thin margin business. So there's no math that can support the Tesla valuation that it currently has, but that's another bubble that we wanted to point out. So we have a market overvaluation bubble, we have interest rates that are very low that are causing this. One last thing I'll mention is in the credit markets. We have low interest rates on agencies, corporates, treasuries, mortgage backs, municipals. Those are all down. But treasuries all by themselves in the last 6 months have gone from 0.47 on a 10-year to now we're over 1.1%. That's started to go up. The other interest rates haven't. So that's meaning that the canary in the coal mine is when interest rates on a country's debt starts to go up, that means that there is a loss of confidence in investors around the world in that country's debt. So it's interesting to watch. This is Brian J. Decker signing off. Hope you have a great week.